Scott Meinert of Guggenheim Partners. Scott, it's a pleasure to have you on. As always, you really rattled some people with your latest note. It's always provocative, but this one particularly so. Your first line, quote, "I have come to realize that the markets are potentially on a collision course for disaster." What did you mean by that?
Well, Brian, first off, I appreciate you, acknowledging my literary skills. But the reality is that monetary policy and fiscal policy are both heading in directions which are contradictory to each other. The expansion now is getting into the late stages. Fiscal policy under the Trump tax cuts is highly stimulative, and that's pushing the economy to grow and to expand at a faster pace, just at the same time that we're running out of workers and wages and prices are starting to feel upward pressure. So that, on the other hand, leads the Federal Reserve, whose mandate is full employment and stable prices, to have to say, hey, we really need to pick up the pace of monetary tightening. And in the process, we're going to push interest rates higher and we're going to make credit more restrictive. And once the first stimulative boost from the tax cut starts to dissipate around 2019, all of a sudden corporations are going to be facing higher interest costs, and the increased growth in cash flow is going to subside because the tax cut deal, though it's permanent, the growth free cash flow is a one-shot deal. And with record levels of corporate debt, they're going to find it very difficult to service this debt in a higher rate environment.
2019 sounds so far away, and then you realize, wait a minute, that's just next year. But can't corporations do, A, Scott, what they've always done, and B, what American households do, refinance?
Well, except the problem here, Brian, is they're going to refinance at higher rates. And even though this tax cut is freeing up a lot of cash, over 40% of corporations surveyed say that their intention is to use this free cash flow to repurchase stock. Another 40% are talking about using it for increased M&A activity. 10% is being given back to the employees, and 10% is basically going out the door in the form of dividends. So there isn't going to be a cash windfall that sits on the balance sheet of the corporations. They're going to end up using it all, and as interest rates keep ratcheting higher with record levels of corporate debt, it's going to be harder and harder to service. And at some point, as the economy starts to mature and cash flows begin to stabilize and decline, it's going to be difficult for everybody to pay all this interest.
Are you suggesting a wave of defaults?
Oh, absolutely. I think that with corporate debt at these kinds of levels, our internal research shows that once you get short-term rates up around 3%, that we will be absorbing enough free cash flow that the free cash flow on corporate income statements will fall to a level which is consistent with levels that we've seen in prior recessions.
So are you calling for a recession in 2019?
Either late 2019 or more likely in the first quarter of 2020. And of course, with all this debt on the balance sheets, as we saw in the last crisis, Brian, the household sector was over-levered. In this cycle, the corporate sector is over-leveled, and so the defaults are going to be concentrated in corporate America, where in the past downturn they were basically focused in areas of consumer activity.
Does that mean that equities would also fall, or can equities and corporate bonds go in opposite directions? They don't normally, but could they?
Well, look, I think for the next year, even with the current tariff tantrum that we're in, that equities will probably continue to go up as we have all these stock buybacks and increased free cash flow. But ultimately, when the chickens come home to roost and we have a recession, we're going to see a lot of pressure on equities, especially as defaults rise. And I think once we reach a peak that we'll probably see a 40% retracement in equities.
Your thesis is about the Federal Reserve raising rates. Is there anything, though, in what you call the tariff tantrum that might suggest that if indeed we start to see some kind of a increased trade fight or even an all-out trade war, because right now everything is just proposed, if we see that, could the Fed slow its pace of rate hikes and maybe dial back some of the more dire predictions?
Well, look, that is absolutely a possibility. When you remember that the Fed was raising rates in 1987 and then was confronted with a stock market crash, that it quickly reversed course and cut rates. Or you look at 1997 when the Fed was raising rates and then we had a crisis in Asia and it reversed course. Obviously, these exogenous events can come in and basically do a reset. But ultimately, Brian, all that will do is defer the problem further into the future and allow excesses to continue to build. And the collision course that we're on will just come later, and it'll probably be worse.
But, listen, you yourself know the Fed could surprise. I mean, you and I spoke a decade ago, and you suggested to me and others that the Fed could actually buy debt directly, and sort of people laughed at you in a way, but that's exactly what ended up happening. The Fed is not the Fed of old, is it not? They have the power to surprise and do things that we don't expect anymore.
Well, that's true, but when you consider what their dual mandate is, that is, to maintain stable prices and to maintain full employment, they have shown that they will not deviate from that mandate unless faced with crisis. And so my belief ultimately, Brian, is that when faced with the moment of crisis, the reaction time for the Fed will be much faster this time around. But ultimately, if it is going to be as bad as I think it will be, we'll be right back into buying bonds onto the balance sheet of the Fed, and QE will probably be in the trillions of dollars.
I'm starting to see ads for no money down mortgages, Scott. I read an article in the USA Today about how people are now buying homes sight unseen, about how people are buying homes that are 7 and 8 times their annual income. And I'm wondering if we're doomed to repeat the mistakes of 10 years ago. What the consumer does is one thing, but do you think that the financial markets and the banks are stronger and smarter than they were a decade ago?
Well, I think certainly with the increased regulation and the enhanced capital, the financial institutions are a lot sounder. Also, Brian, when you look at the affordability numbers on homes, that is the relative income to the cost of paying the mortgage, homes are a lot more affordable than they were even 20 years ago. So I don't think we're going to see the crisis really spread into that sector in a major way. But where I do see risk is in things like commercial real estate. When you look at the skyline of Los Angeles or New York or any city that I visit, you just see cranes everywhere. And there are certain sectors like multifamily housing where the overbuilding has been extreme. And interestingly enough, just like in the prior crisis where homes were, basically being subsidized by Fannie Mae and Freddie Mac with cheap government financing, today commercial mortgages on multifamily housing is being subsidized by Fannie Mae and Freddie Mac. So, the overbuilding and the excesses which are starting to appear in real estate will probably be the second order effect to the recession I see coming. The first order effect will be actual corporations which will lay people off, will default on their debt, and then the second wave will be in declines in real estate values for commercial properties.
Sounds like the good times are going to be coming to an end at some point here soon. Scott Minerd, Global Chief Investment Officer of Guggenheim Partners. As always, thank you.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.